Thank you very much. Welcome. On behalf of Bank of Melbourne, you would have heard that we do have an interest in manufacturing here in Victoria. We are the only bank here in Victoria that focus and specialise in manufacturing. So we're very pleased to be able to take the opportunity to present here today. I'm also joined on stage by our Head of Financial Markets, Andrew Pryor, and also our Working Capital Finance Specialist, Tom Wright. So welcome, thank you. The presentation today is going to go through two parts. First and foremost, our experience in manufacturing is that there is a very high requirement for that working capital finance cycle. So from the purchase of raw materials right the way through to production and therefore sale and financing that end to end. Tom's going to take you through that. And then we thought we'd give you more of a general economic update. A lot happening in the marketplace, especially with the election coming up this week. And so Andrew's going to join us on stage and talk about that. But I will now hand over to Tom Wright, who'll take us through a presentation on working capital finance. Thanks, Tom.
Thanks, Andrew. Good morning, everyone. So today I'm here to talk about working capital finance. Basically, when I talk about working capital, what I mean is cash, which is really the lifeblood of every business. I think what every good business owner realizes pretty quickly is that you can have a fantastic product and a good client base, but if you can't convert your sales into cash in your bank account, there's a real difference between a successful business and one that probably doesn't achieve its potential. So what the issue here is that many businesses don't have their finances structured correctly to maximize their capital and then also to achieve their business and personal financial goals. When your cash flow isn't working for you, you're very limited in what you can achieve. The challenge that we find more often than not is that they can't, that they're trying to leverage real estate assets, look at traditional funding mechanisms to achieve these goals. So what our approach at the Bank of Melbourne is that we look at each individual business as a unique business. We know that each has a unique trading cycle and a cash conversion cycle. And we bring our expertise in the market to provide an appropriate debt structure that really works through that for a different client.
I'll do my part.
So up on screen now, I've got an example of an operating and cash conversion cycle, which is pretty typical in the market.
I'm happy to do a Q&A.
What we're looking at here is a period from ordering the goods, which might be raw materials or it might be a finished product.
Good idea.
A shipment period, which typically out of China, as an example, might take 30 days. And then an arrival period where there's a stock holding process and a period where you raise your invoices and offer your terms to your clients. Overall, as you can see on screen, there's a cash shortfall of around about 180 days from when you have to make your payments to your supplier, hold your stock, and then collect out from your debtors. The way we look at this is the front end of finance and the back end. Your front end of finance is looking at that trade finance solution as we have up on the screen. So when your goods haven't been sold, but you might be converting into a finished product to sell to your clients. The back end here is the debtor period, once you've sold your goods, but you haven't collected your funds as yet. At the bank, we have two solutions that work for you. On the front end, we have trade finance. Trade finance is essentially a flexible, short-term, fixed-rate finance that we do on a rolling basis. It's available in multiple currencies, primarily Australian dollars, but also in Euro, US, and all other major currencies, which can create a natural hedge for a business. Takes out that the foreign currency risk that many businesses have to contend with. It's also a really useful tool for cash management. So it essentially funds your cash flow while there's a stock holding period before you've actually converted it into sales. The important part of where we get involved is aligning that finance tenor to match your cycle. So we're looking at the original period of either delivery or converting into goods, and then a sales period and stock holding period, and making sure that the finance we give you meets that. What we also do, and which is a bit different to other suppliers of this product, is that we do it for both domestic and international suppliers. So we can fund a shorter period if it's coming from someone within Australia, or a longer period if it's coming from overseas. Obviously, if you're looking at a cycle where you're ordering from the Europe or the US, you're looking for a longer period than if you're coming from China. And again, a longer period than if it's just coming from somewhere in Victoria or in New South Wales. The really important part about trade finance for that front end of your finance is looking at maximising it to negotiate payment discounts from your suppliers. If you have the ability to offer payment on shipment, you can go to your supplier and say, look, I'll speed up your cash conversion cycle, and in return, give me something back. Generally, that can be somewhere between a 2% and a 5% discount, depending on who you're dealing with. Conversely, if you're dealing with somebody who doesn't want to give you terms on your supplying, providing a letter of credit or a standby LC gives the supplier that confidence that they're going to get paid once they shipped it out. And therefore, you can negotiate terms on the back of that. Now we go into the back end of the finance. So once you've had your good, you've stored it or converted it into a product and then sold it and raised the debtors, what you find is that your clients will often ask you for terms. Terms usually range 30 days, 60 days, end of month, which gives you up to a 90-day period where you haven't got your cash in from your sale. What we do at the Bank of Melbourne is provide a confidential working capital facility, which means that you own the account, you own the collection process. We don't even get involved with your clients, and it's all up to you there. We can provide up to 85% of the approved invoices for funding until you collect out on them, and it works on a rolling basis. The interest is only charged on your drawn balance at any one time. And as I said, all collection-based activities remain with the company. We also offer, which is unique, a foreign currency availability. As I was talking about with the trade finance before, there's a natural hedge there. If you buy from your suppliers and owe them in US dollars, and then you sell on in US dollars as well, you create a natural hedge there where you don't have to convert to an AUD in the process, and therefore, again, take out that foreign currency risk. If you can see from that bottom bit what the benefits are here, you've got a constant line of credit that doesn't rely on any other security other than your debtor book. You've got limits available from 500,000, and we expect that to fluctuate with the business needs. And we can convert invoices to cash within hours. Things that we fund for, and this is a really important part of being in a business. If you're going through a product launch and you don't have cash flow to support it, putting in debtor finance can give you that. Again, it doesn't rely on a physical asset like a property supported, so we can fund that growth as the business goes through it. If you're getting through a new major client or a new major contract, it can have that same impact. You've also got changes in your supplier and major debtor terms. As I spoke about before, if they're trying to contract that or push out their debtor terms, it's elongating your cash conversion cycle, which can have a material impact on how well your business does. Similarly, if you're going through a strong revenue growth for a product that you have, but you can't continue to invest the profits in and you need some support there, we can help with that. Where we're looking at purchases of plant or equipment from overseas, that comes in with the trade finance. It's not always ready to be funded under equipment finance, so we're using trade finance to get your good into Australia and then fund it on equipment finance can really support a business to take their production to the next level. There's also moving from domestic suppliers to overseas suppliers, which again, you need a longer period for transit, so we're looking at a longer term there. And the big one is when a business from its inception has a property owned by one of the directors tied in with their funding solution. We can look to pull that property out, give you an alternative funding solution so that the directors or owners can use that asset for their own wealth creation purposes. And that's really important going forward. You know, transitioning a business is not easy, and trying to get the most out of it. If you're always having to put your profits back into your cash flow cycle, you can be really restricted personally in what you can achieve. And so it's a really important part of what we do. To touch on a few of the items here, I'll just pass on to Andrew Pryor, who's going to give us an update on the economics situation at the moment. Thanks.
Okay, thanks everyone. My name's Andrew Pryor. I represent the Bank of Melbourne Financial Markets team here in Victoria. My role is not as an economist. I work within financial markets and predominantly dealing and assisting our clients with managing interest rate risks. So what we'll do today is provide a really brief summary on what's currently driving fundamentals across financial markets, the economic landscape, and what we can expect in the years ahead. Because certainly it's been an interesting 6 months, and we have seen a lot of change. So advice provided today obviously is a general nature only. Haven't taken anyone's personal situation into account. We'll have Q&A afterwards, but again, if you have any queries or questions along the way, feel free to put your hand up. So firstly, global growth. You can see there that the IMF have downgraded their world growth forecasts for both 2019 and 2020. I guess our average world growth is just under 4%. What we have seen is on the back of a trade war which has broken out obviously between US and China. There's a lot of threats being made, and certainly Trump's been quite consistent in his discussion around raising tariffs, and China have effectively come back and said they will do likewise. So that's impacting trade, and Australia certainly is going to be impacted across all industries. Despite what the government can try and do to do one-on-one deals with the US, we will be impacted. And as you can see from that, world growth is going to be impacted as well, which probably sets the landscape for around interest rates. The Federal Reserve, the US Federal Reserve, they have been in a upward scope around monetary policy, so they've been raising interest rates. From now on, though, the expectation of the market is that pricing will remain as is, and the likelihood is if we do see the slowdown, which will probably occur as a result of the ongoing trade war, that the US Federal Reserve will actually, in the months ahead, will be looking to potentially ease their interest rate policy, just like we are doing. But again, our long-term interest rates are effectively manipulated and influenced by what happens in US markets. So it's why they are important for domestic and also world interest rates. Our own economic outlook, the Reserve Bank, in their statement on monetary policy last Friday, they've downgraded the economic outlook for Australia. 2019, they're at 2.75%, with a further downgrade down to 2.5% in 2020. Our own group forecast is that things are going to be a little bit slower than that. And you'll see there 220 on both 2019, 2020, and that will provide, we believe, the impetus for the Reserve Bank to cut interest rates potentially next month, which was alluded to this morning by Terry McCran in the Herald Sun. But with economic growth below average levels at 3%, with inflation and price pressures very subdued, as is wage pressures, and the employment position starting to deteriorate, the door is open for the Reserve Bank to do something, and the likelihood is they will cut interest rates sooner rather than later. From an economic perspective, locally, we've got a few issues which have been driving our economy. Obviously, tourism and education are two of the main items. And what they have done is take up some of the slack from the fall down we've seen in building and construction. Now, that's been a slowdown which we've much often talked about. It's in the media. We've seen housing finance slow down, and we do think that's going to continue. But that's two things, along with the infrastructure spend, the public spend. That's what has been driving our economy. The Aussie dollar, for those of us who do have an exposure, the Aussie slipped through 69 overnight, so wouldn't have been helped by the article this morning from McCran, which said that the Reserve Bank are going to cut rates. You can see there is a relationship between Aussie and commodity prices. Commodity prices have actually been quite resilient, and that has provided support for the currency over the last 6 to 12 months. On the other hand, you've got interest rates. Now, when the interest rate differential between Australia and US starts to widen, and at the moment US rates are actually higher than Australian rates, that does put downward pressure on the currency. And as you'll see there, we do expect the Aussie to continue to weaken over the rest of this year, because there is going to be little support for the currency, despite we do think commodity prices are going to remain relatively strong. Business spending. Look, business spending it's been okay. The issue, of course, is with the pending election, which was called a few months ago. Businesses do tend to go back into their shell somewhat. There's a little bit of uncertainty. Businesses don't like uncertainty. But compared to the consumer, business has been relatively strong. What happens and the impact of a potential change of government after tomorrow, that remains to be seen. So very hard to hypothesise on what the outcome of the election will be and the impact to business and business investment profiles. Housing, we all talk about housing and house prices, but certainly we know there's been a slowdown. It has been predominantly across Melbourne and Sydney, but it has been obviously Australia-wide as well. And when we do see that housing downturn, we have what we call the wealth effect. And people, as your house prices go down, people feel like they've got a little less money in their pocket. They actually feel they're worth less. So that does impact saving, it impacts spending, and that has also had an impact on those earlier projections we showed around economic growth. The leading indicators we have around building approvals, housing finance, the numbers are really soft. There's been a lot of, media scrutiny around bank lending to housing finance. We know in a post-Royal Commission world, things have got a whole lot more difficult, especially around those investment loans, interest only. The banks have tightened up their lending criteria, which has made it more difficult for borrowers to get finance. That's also leading through to a slowdown in building approvals. People are no longer buying off the plan as strongly as what they were 18 months ago. So we still think this is going to, there's probably a little bit further to go, and will be one of the more weaker sectors of the economy. I talked earlier on the wealth effect, so I won't dwell on this one, but again, as properties come down in price, households feel like they've got less wealth, less income, and accordingly they will adjust their spending habits. Changing consumer trends, we have seen this filter through to our retail sales numbers, and retail is one sector where internally we're seeing there are some very soft segments of the retail sector, and with the changing habits of people going more online, looking to purchase offshore, this is one area where we think there's going to be continued pressure on the economy, certainly with the house effect as well, more tighter economy, potentially an employment rate which is increasing, which we saw yesterday. We still think the consumer's going to be not aggressive in their buying responsibilities. Labour market, yesterday actually probably was the first time that we've seen a significant jump in the unemployment rate. Unemployment's now at 5.2%. It was down at 4.9% at the start of the year. So even though participation has been picking up, employment has been the bit of the canary in the coal mine, because the Reserve Bank have said they weren't going to actually touch the cash rate until they saw those signs that employment was starting to deteriorate. Now, the fact the unemployment rate's now increased, that has effectively opened the window, and it's the last box that needed to be ticked around cutting monetary policy, because we still have subdued inflation, subdued wages, with employment deteriorating. Certainly, it's green light ahead now for the Reserve Bank to start to pass on a little bit more impetus and stimulation to the economy. Inflation has just been very subdued now. The RBA, they set a band of 2 to 3%. We've been under that 2% band for some time now. There has been talk the Reserve Bank may even adjust the band so that we no longer have a target at that level. But the big one has been that wages, and we haven't seen wages growth at all. Certainly it's something which Bill Shorten's been pretty public about, and trying to say that one of the first things he will do will actually be to increase wages. That'll happen day one. So the impact that has on business, that remains to be seen, but certainly the population will be crying out for wages growth. Whether or not that feeds through to inflation, whether or not it's sustainable, that's another thing. The Reserve Bank, as I touched on at the start of this presentation, The group view we have was that the Reserve Bank would cut rates in August and November this year. Following yesterday's employment data release, there is a strong school of thought that effectively the Reserve Bank, with the federal election out of the way, they will move on interest rates and cut the cash rate from 1.5 to 1.25. For what it's worth, the view is that the major banks will actually fully pass that on to consumers and those with variable home loans. That's what we call the timing debate. So the Reserve Bank actually haven't done anything since August 2016, so it's effectively almost 3 years since we've seen some movement there. The impact of any movements in the cash rate and whether or not it actually changes spending habits and it does provide an impetus to the economy, that's the great uncertainty. But keep an eye out for first week in June. All eyes will be on the Reserve Bank and a potential announcement of an easing in monetary policy. A disclaimer to finish, and I'm happy to take any questions or queries or comments from the floor, or if you like, just come up afterwards and have a chat with Andrew, Tom and myself if you do have some specific queries. Thanks for everyone coming along today. Andrew, you want to wrap up?
Thanks, Andrew. As I say, we've covered off on a couple of topics there, what's happening in the economic market at the moment and how Bank of Melbourne actually support manufacturers through that working capital cycle. As Andrew said, there is an opportunity for questions if anyone has one. Otherwise, we will just mill around. Please feel free to come and approach us directly. Thank you for your attendance. Cheers.